Welcome to the Construction Disruption Podcast, where we uncover the future of design, building, and remodeling.
I'm Seth Heckman of Isaiah Industries, manufacturer of specialty metal roofing and other building materials. Welcome to Construction Disruption, the podcast committed to bringing value to home improvement and replacement contractors. This is a bit of a different style episode for us. We will be rebroadcasting a training we recently gave on the changing landscape of homeowner insurance and roof coverage. We have all seen the headlines in recent years, none of them very good. Headlines talking about, the increased frequency of severe weather events, record losses by carriers, carriers dropping policies and leaving states entirely, and a crisis even one level up from them affecting the reinsurers out in the market, pushing them to the brink of bankruptcy. So listen in on this training as we dig into all of these factors, review how carriers and legislators have responded to those conditions and really changed the market in which we're all operating, and start discussing ideas and ways that we understand we need to change our businesses as a result. This is Insurance Has Changed. Will you?
In our time together today, I really wanted to review what has truly been a crisis in the insurance industry over the last few years, and cover how it is affecting and really dig into how it is affecting our businesses and our customers. My goal for our time together is that we'll all hopefully leave with a more holistic view of what has occurred, not just isolated experiences we've had in our own markets, but this bigger picture and context of where this industry is going across the country, and leave better equipped to lead our businesses through those changes moving forward. I'm excited too that we'll be joined in a little bit by a special guest who will share how he is leading through these changes in his home improvement company, and give you some great ideas and strategies as well. And all of this is important because I don't think there is any disputing that severe weather events are occurring at higher rates across the country. Hurricanes, wildfires, hailstorms, tornadoes, all of those events and conditions are happening more frequently and in areas and regions that might really up to this point and recent years rarely experienced them previously. In the past, in our business, this would create significant opportunity for our businesses. We would get out, start knocking some doors, and be ready to help folks rebuild, and eventually be compensated handsomely in return. But as we've all seen, times are changing, things are changing. The claims process is taking longer. Carriers are more difficult to work with, and policies are truly falling short of what is actually required to make those homeowners whole after one of these weather events. This really hasn't just suddenly occurred this year in 2025, but really has been a trend over the last 7 or 8 years. It began in the regions hit hardest by these events, and then the rest, those of us in the rest of the country started getting caught in the fallout. So just as some review of what those conditions and what these last few years have looked like, specifically in those most severely hit areas. Florida is obviously near the top of the list whenever we think about these type of events, hurricanes specifically. And for those of us paying attention, they've been in the news pretty frequently the last couple of years as they have tried to respond to this crisis and made changes to this market there in Florida. They were really forced to do that after they dealt with Hurricane Michael back in 2018 and Hurricane Ian in 2022, with those storms together generating a total of over $50 to $60 billion in insured losses. So carriers experience huge losses after those events. And something I learned in preparation for today, that was going on while, in addition to that, Florida hosted over 76% of the country's homeowner insurance lawsuits. So they had some loopholes and conditions there that made it a very litigation happy environment, with over 100,000 homeowner insurance lawsuits being filed in 2022 alone. Not the most friendly environment for all parties involved. Looking beyond Florida, Louisiana comes to mind as well. And really, over these last 7 to 8 years, again, this time frame we're looking at, during that time, Louisiana was hammered by four major hurricanes just in a 13-month span, resulting in tens of billions of insured losses. Hurricane Ida, which all of us remember back in 2021, that storm by itself was over 10 billion. So this many storms in such a short period of time pushed carriers beyond what they had, ever planned for, what they had ever tested for, resulting in at least 11 carriers in the state of Louisiana becoming insolvent, and many others leaving the state in that process, choosing to no longer write business in Louisiana moving forward. So that's Florida, Louisiana. Third, top of mind for all of us are the wildfires being experienced in California in recent years. And for those of us in this business, noticing the headlines that have come out of that state here, where regarding State Farm and others dropping policies just ahead of the wildfires this year. Those conditions that the State Farm making those decisions on those policies really dates back to 2017 and 2018, where the state experienced two major wildfires back to back. And at that time, California law was unique in that it mandated carriers could not use any future forecasting and calculating their premiums, and instead had to use a rolling 20-year average of costs in order to put those costs on those premiums and get that costing approved by the states. So you had these two wildfires back to back in 2017 and 2018, but those 2 years were simply lumped in with the other 18 years previously up to that point, many of which were low cost, low loss years, and it really didn't make that significant of an impact. So when carriers started doing their analysis and calculating their bottom lines, they knew that they had to make changes, which resulted in State Farm and Allstate, the nation's number one and number four largest insurer, and many other smaller ones as well, began in California declining renewals of homeowner insurance policies and ceased writing new policies. So this was all that groundwork leading up to all those folks getting dropped in, 23, 24, who then no longer had coverage, unfortunately, this year when those Palisades and Eaton fires came through. So these were the headlines. These were the news-making stories across the country that we all know about. But while these huge losses were going on in these notable markets, it most definitely wasn't isolated there, though. So in addition to what was happening in Florida, Louisiana, and California, the rest of the country was seeing a much higher incidence of severe convective storms. These are the storms that produce high winds, hail, and tornadoes. And nationwide, there have been, when we start running the numbers, 6 times as many billion-dollar loss storms. Just these convective storms, 6 times as many of them, hailstorms, tornadoes, etc., in the years since 2001, as compared to the 20 years previous to that. So since 2001, we have had 6 times as many of these storms, billion-dollar loss events, than what we did between 1980 and 2000. These storms resulted in over $60 billion in 2023 alone. So not just isolated to these major markets, we're seeing a greater incidence and higher losses nationally, which has meant that all this severe weather across the country has resulted in carriers losing money on their underwriting 6 out of the last 7 years between 2017 and 2023. So 2023 is the most recent year that we have this data. So in that 6 year, in that window there, they were losing. That's a 6-year window. So they were losing 5 out of the 6 years in that time frame, they were losing money on their underwriting. And in the most recent data, again, that in 2022 and 2023, it's showing that these carriers are paying out $110 in claims for every $100 they collect in premiums. So underwriting this business of calculating a premium, what you're going to cost for this insurance, charge for this insurance, and then weighing that against the potential for a claim is notoriously a low margin business. There's very little margin for error there. So this type of flip started having dramatic consequences pretty immediately. If you'd like to learn more about this, I recommend Acquired Podcast's episode on Berkshire Hathaway. It's a good one. But these insurance carriers, they play this knife's edge on claims versus premiums. And here in these recent years, with all of these events, all of these losses they were incurring, started looking pretty bad for them pretty quickly. And these losses were started by all these severe weather events, but then they were compounded even more by something we are well aware of in our businesses, where since COVID and beyond, replacement construction costs have increased by over 30%. So the news just keeps getting worse and worse. Just covered a lot of ground, trying to give, again, some of this context of what's going on. But also, I want to say the goal here isn't to start painting this like sympathetic, woe is them picture of the insurance carriers. This is the business they're in, and we all have sort of stories and examples of them not fulfilling what we believe is their obligation to an individual homeowner. But again, trying to look at this greater context of what's been going on in the market at the macro level, the big picture level. With all of this, it's easy to see that this model, paying out $110 in claims for every $100 in premiums and losing money year after year, it's easy to see that this model isn't sustainable. And the problem really extended another layer up beyond the carrier. Where many of us have seen recent headlines that there's not just been a insurance carrier crisis, there's been a reinsurance carrier crisis. The insurance for the insurance companies. Before allowing, carriers to write policies in any state, those states typically stress test carriers to ensure their ability to survive, a 1 in 100 year catastrophic event. Some states even set the bar higher than that. I think Florida was like a 1 in 130 year event. Carriers aren't capitalized themselves to, just be sitting on enough cash to be able to write those checks if that event occurs. So this is where reinsurance comes into play, where insurance companies go buy this reinsurance in order to cover those gaps. With all these recent events in those key states and then across the country as a whole, claims against those policies had to be made, and reinsurers then started sharing in the cost, resulting in reinsurance costs increasing by 37% in 2023 alone. So reinsurance, it's interesting. It's largely funded by the selling of insurance-linked securities, most of which is generated by selling a bond called catastrophic bonds or CAT bonds. With all these losses, in addition to claims being made and cash being outlaid, demand for those bonds thus dropped. People didn't think you can make money buying the bonds, so they spent their money elsewhere. So in addition to the cost going up, the amount of dollars and funds available for reinsurance started dropping dramatically. So it was more expensive. There was less of it available. And even some states like Louisiana and Florida had to even take steps to start subsidizing reinsurance there so carriers could meet stress standards and continue operating. So it's been a mess. All of these factors coming together, it's created a mess for these carriers, created a mess on the state level, and thus we're seeing the fallout then for us and our businesses and our homeowners. But taking a true view of what this picture has looked like, what this data has meant, insurance companies are in the business of making money, they obviously couldn't continue operating at these losses, dealing with these reinsurance challenges, and really the entire infrastructure of this industry was imploding. So again, we all have our stories of carriers operating unjustly, but changes really did have to be made. And those areas of the country that we already covered, were the areas where the industry was most affected, really started leading the way in what those changes were going to look like. For the carriers, the policyholders, and then even us as the contractors in the mix as well. So when we start looking then here at what changes were made and how that then started affecting the market. Florida has really been the most aggressive in legislating reform. It outlawed, first and foremost, it outlawed the one-way attorney fees and the assignment of benefit contracts that drove all those lawsuits. Again, 76% of the country's total lawsuits were happening in Florida, obviously not creating a friendly market for those carriers. So the new legislation outlawed the key factors that drove that litigation. And then Florida was the first state we know that we started hearing about carriers mailing letters to homeowners with roofs older than 10 years old, requiring them to replace the roof if they wanted to maintain their policy. So this is where we first started seeing that tactic be enacted by the carriers. This new legislation did address that, where it limited carriers from dropping policies solely due to roof age for roofs younger than 15 years. But when you dig deeper in what homeowners are finding, roofs older than 15 years, if you have a roof older than 15 years, you have to have it inspected. And it must pass that inspection really with an expectation that it's going to last at least 5 more years. So for all, thinking about what this means for those homeowners, for all those homeowners with asphalt shingles or cheap tile that are 15 years old, they maybe have been bought an additional 5 years with this new legislation. But for those more temporary roofing solutions, they're still going to be in this cycle of replacing those roofs earlier than they thought they would have to. In addition to these couple of changes, the state now allows policies to include a separate or additional deductible for wind or hail roof damage, up to 2% per home value or 50% of the replacement cost for a roof. It allows carriers to enact premium increases more frequently than once a year if reinsurance costs increase. So giving carriers more flexibility to price ongoing as the market changes. These are increases to policies that on average are already at $4,000 a year for the average homeowner policy in Florida. Law used to require a full replacement if over 25% of an older roof was damaged. And now that threshold is 50%. And this new legislation regulates how contractors can advertise storm-related roof replacement services in Florida. So a number of changes here we hit on quickly. When we look at the list in total, it's easy to see, quick to see that little of these changes are in favor of the homeowner. And definitely none of them are in favor of contractors. But the state really had no choice. They made the choice, or they made the decision that some insurance coverage was better than no insurance coverage. So as this was going on, they made this choice. They knew they needed to make the market more friendly for carriers. So it was interesting as all this was being passed. There was a quote that came out by the Florida Insurance Commissioner in an interview he had at an event that got all of us in metal roofing pretty excited because he came out and said, it's probably time to look past asphalt shingles. These products that are guaranteed to last 30 years, they don't last 30 years. They just don't. So we really liked the sound of that. That got us excited. Think there might be some increased opportunity down there moving forward. But a couple of weeks later, he had to walk it back. And he made the comment, there is no toggle switch to suddenly change roof types. So that was the end of that conversation or any sort of maybe grand legislative opportunity we felt like we had down there. So Florida was most aggressive. They made all those changes. It's been a little bit simpler in some of these other states. Louisiana really had fewer options after sustaining, so many losses over such a short period of time. Those 11 carriers went out of business. Many others left. And those that remained, really, what's been a common trend is they stopped writing policies in the most vulnerable areas. So if you're going to get hit by a hurricane, we don't want to be the one insuring your property. So this really resulted in a dramatic increase in the number of policies held by the state's insurance of last resort. And the law states that as a deterrent to keep folks from being on that program as best they possibly can, the insurance of last resort has to be the most expensive insurance on the market, which meant that the state increased premiums by 63% in 2023 alone. We do a lot of business in Louisiana, talk with a lot of good folks down there. And unfortunately, we've heard from many of them that they're now paying $10,000 or more for a premium on their homeowner insurance policy. The state tried to incentivize insurance discounts by offering some grants for homeowners who are upgrading to fortified home standards. A fortified home is a building standard that established by the insurance industry itself. That's very similar to Florida building code requirements. So the state made these funds available as grants for homeowners who are trying to make those upgrades. But the funds were obviously in short supply. The discounts were of little relief when you compare them with what these increases had been. And the construction cost to build to these standards was significantly higher. So really little traction was made on that front either. Out in California, like I mentioned, that previous legislation that forced that 20-year rolling average in terms of pricing out policies, they did away with that. They now allow carriers to price with that future forecast and under a forecast on if the prevalence or frequency of these wildfires is going to continue. And then also pricing in these reinsurance cost changes as well. It's interesting out there. The California Department of Insurance also has the option of surcharging all policyholders in the state in one fell swoop if they need to help cover losses. So in a recent year, every policyholder in the state had to pay $50 to help cover some of these recent fire losses that have occurred. And their insurance of last resort is growing, especially in supplemental fire-only policies to supplement for the private carriers not wanting to write them. Unfortunately, it's interesting. We really have not yet seen the effects on these recent fires, the really big ones that happened this year. Estimated that the Palisades and the Eaton fires were over $50 billion $20 billion in losses. And what's been interesting is that California has had to take the step of issuing a moratorium on any policy non-renewals, any drops, and moving forward. And that moratorium was for all of this year, and that is set to expire in January 2026. So unfortunately, it sounds like there's going to be another bloodbath out there early next year of, premium increases and non-renewals once insurance carriers are allowed to start making those adjustments again. So I wanted to cover, some of these nitty-gritty details to again give the picture and help us all understand that the legislative reform being passed, how states are making adjustments to really address what this crisis looks like, is clearly aimed at making markets more favorable for carriers. States have decided, again, that some insurance coverage is better than no insurance coverage. And remember how I said that, demand for those reinsurance bonds had dropped in those years, limiting the amount of funds that were available. As these changes have been made, demand has gone back up again. People now think you can make money again at insurance. So the market thinks it's trending in that direction as well. There is no light on the horizon, nothing on the horizon that indicates legislation is somehow going to bring us back to, full RCV coverage, $500 deductibles, and guaranteed matching. It's simply not going to happen, and we're really seeing the effects of this nationally, where premiums have increased by over 34% between these years of 2017 and 2023. And we're seeing these reforms that have been addressed in some of these first markets, like separate roof deductibles and ACV coverage, especially actual cash value versus replacement value, being written into policies just in other areas of the country, just like in Florida. So these changes really hit home for us when Meredith Miller, our founder's wife and the mother of Todd Miller, our president, she received a letter from her insurance carrier last year after a hailstorm and tornado hit our area. This is a picture of her beautiful 30-year-old metal roof here on the right. 30 years old, just as secure and beautiful, today as it was first installed. But she got this letter, and unilaterally, her policy was changed to include, a separate higher deductible for wind and hail roof claims, ACV only coverage for a roof more than 10 years old, and it denies matching coverage, despite Ohio being a matching state. So not sure yet how that is legal, but they're trying. So weighing, I guess, how many fights they'd have versus people just rolling over. And this is in Ohio, one of the most mild environments in the country. I was having a conversation end of last week with one of our customers in Michigan. He said half of our leads right now are homeowners who just received a letter from the insurance carrier threatening to drop their policy if they don't replace their roof. In Michigan, this isn't Florida, Louisiana, Dallas, Oklahoma, Michigan. So what does this all mean for homeowners? How does this math play out? If they're living in a $300,000 home and need to replace their 10-year-old roof, let's say the true replacement cost for that asphalt shingle roof is $20,000. But when you start factoring in some of these other dynamics, it's first going to be that amount is first going to be deducted by whatever that depreciation schedule is. 17% came out of a policy I read from a homeowner in Wisconsin here recently. So right off the top, $20,000 to replace, but we're going to take off $3,400 in depreciation. From there, if you have one of these 1% to 2% of home value deductibles for roof claims, just like that, another $3,000 to $6,000 comes off, bringing the true claim value at the end that homeowner receives to somewhere between $10,500 and $13,500. Well short of the $20,000 it costs to get that roof replaced. If it was even approved for a full replacement, which we know that's even more difficult than ever to get approved. But even if they do get approved for a full replacement, their claim is going to be way short of what they actually need to get that project done. And you're left standing in the front lawn with them, trying to explain why all of this is the case and help them come up with the difference. So that's the impact for the homeowner. This is the reality that really we're going to have to educate them on, that they're going to be facing at some point in the future. Impact on you and our businesses. This game has changed dramatically for those of us that have done a significant amount of restoration work over the years, where legislation against those assignment of benefit contracts and an increased number of class action lawsuits and litigation against roofing salespeople operating as public adjusters when they're not licensed to do so really has put the fight back on the homeowner, that they're responsible for fighting, going round by round with their insurance company, trying to get paid what they're due for that claim. Few homeowners are going to have the time and energy to walk through that process. That's just the reality. I was working with some folks here recently that they had a legitimate claim probably, but at a certain point, they just responded finally to me with, we'll live with it. They were done. They got tired of it. And I think we're definitely going to be seeing that more and more. And what that means is then for our businesses, we're going to be doing more repairs rather than replacements, whether it is because they only got approved for the repair, or whether it is that claim is so short of what the replacement cost is, the homeowners will only be able to be approved for or only be able to afford the repair. And we're seeing more and more of our customers, contractors across the country, struggle with this additional dynamic of actually getting paid for the work that they do. I just read a policy that gives the carrier 180 days to pay 50% of the claim. Think they're letting that contractor make 50 points margin on that job? Absolutely not. So that contractor is stuck in a spot of carrying that job at a loss for up to 6 months, creating all sorts of cash flow issues and challenges. And if you've been paying attention, you heard about the AccuLinks, one of our industry's biggest CRM and project management programs, just getting acquired by Verisk. I didn't know who Verisk was when that hit the news, but learned more that it's a data analytics firm serving the insurance industry. So do you think they want all the data and AccuLinks to make you more money, or to make their insurance partners more money? The writing is on the wall there as well. And really taking all of this into consideration, taking this holistic picture, from our perspective, the data really is clear. The picture is very much clear that ultimately insurance has changed. And the question being asked to all of us is, will you? Are we going to understand where this is going? Or are we going to lament and hold out hope that somehow carriers and their just goodness of heart are going to start being easier to awarding more claims and easier to work with? That's certainly not going to be the case. And we need to start making strategic decisions in our business to addressing this changing market, addressing where it's going, and still be successful regardless. So to spark some ideas, and really hear how someone out on the ground floor and dealing with this with homeowners is making changes. I'm excited to have Brad Black, owner of High Performance Roofing in Frisco, Texas, joining us today for on this session. Brad and his wife, we've known them for a few years now. They really are building a great company, and out of all the contractors we work with across the country, one of the ones leading with just a great level of foresight, understanding where the industry is headed and strategizing accordingly. So, Brad, thanks so much for joining us today.
Yeah, glad to be here.
So I know you're obviously dealing with this day in and day out in DFW with high performance, but know you're involved in some, mastermind groups and other industry connections, hearing what others are facing across the country. But I guess just start with, was this a pretty clear, are you seeing this picture play out and in your operations? And really, what are the most significant or common changes you're finding in home policies that for homeowners that you're working with, as compared with what those policies and the process looked like, a few years ago?
Yeah, for sure. So in the past, so I've been selling roofs in the Dallas area since 2014. And then my wife and I started our company in 2016. So about 10 years, actually, in about 2 months. And in the past, there would always be ebbs and flows, and insurance carriers maybe being a little more lax, maybe getting a little tighter. We'd always know which companies, were a little better than others. But in the last couple of years, it's really shifted. So kind of what you were talking about in the Dallas market too, specifically just being so competitive. So I think what happened for us, there's kind of a combination of things, because our market was a very, before like 2020, cover your deductible kind of market. So most every roofing company just went ahead, found a way to basically get the homeowner a free roof, right? So most homeowners also got used to that. And so the challenge now that things have shifted, deductibles going up, it's not like they all went up at the same time for every homeowner and they all realized it. So now when we have a new storm, what happens is you'll have some homeowners who maybe still have a 1%, and then you have some homeowners who have a 2%, but both of them think they should get their deductible covered. And then us as a company, back, when the law changed in 2019, we really made a decision. We're not going to cover deductibles anymore. And usually even before that, the way a homeowner kind of got help with their deductible was, collateral items that maybe they were choosing to do. We just do the roof, and the homeowner would kind of offset that with the ACV funds, which is the kind of the legal way to do it, right? So, but a lot of the roofing companies, even a lot of the big ones, even the ones bought by, private equity, and which some of those are even linked to the insurance company, they're still covering deductibles right now. And so that makes it very difficult. But what's happening though is there is a shift in homeowners starting to realize, okay, there's something shifting here. I need to do something different. And so us as a company, our goal is really educating the consumer on why they need a better roof than, and not just put the same roof on they always did. And so one of our challenges is breaking that mold, because you have a lot of these homeowners, they might have changed their roof out 3 times in the last 10 years. And so they got used to just being like, oh, I'll just, and it's interesting, the homeowner's mindset, because this is what makes them almost not care who changes their roof and how good or bad they are or whatever, because they're not paying anything for it. And so when you're not paying anything for something, and or you think that you're going to get it paid for again next time if anything happens, someone could knock on your door and be like, oh, sure, I'll work with you. You seem like a nice guy. That's starting to shift. So so in the insurance industry too, I have an insurance broker friend here, and I actually made a video with him and kind of interviewed him on the changes, what's going on in the insurance industry. So he gets on calls in his side, being an insurance broker, and a quote from kind of a leader in one of the insurance kind of organizations was basically like, hey, we're done being a homeowner's home maintenance company program. Because a lot of homeowners would be like, oh, great, I got a claim. Now I can get my fence stained and new gutters and, kind of fix my house up because I got this money coming in from the insurance. Insurance companies are like, we're done with that. And so what I've noticed with these deductibles, 2%, we had a homeowner the other day, they have a 5% deductible.
Good. That's great.
I mean, that's basically like you're not insured. I mean, you might as well not even have insurance. And so, yeah, we're having to really be better about offering financing and the value of having a better roof. So that way, next time you don't have to file a claim, because you're better protected. But when you have these other roofing companies still going around telling the homeowner they'll cover, or at least a lot of them now will just cover, half their deductible, because if it's 2%, they're like, I'll guarantee I'll cover you 1%. That's kind of what they're doing. And so what we're doing now is, so we kind of created our own trademark name for the metal roof. We call it the Texas Proof Roof, and really are marketing that. And then also, even when we do asphalt shingles, we're always doing class 4, your better rubberized asphalt type shingle, because that's really what the homeowner should do. And ideally, we just have to sit down at the kitchen table and show them the numbers and why putting on a better roof and investing in your home now is what you need to do because of these insurance changes. And the homeowners oftentimes just haven't heard about it. A lot of the homeowners' policies have changed and they don't realize it. They get a letter in the mail, they don't read it. Their deductible went from 1% to 2%. They have an older and 10-year roof, so now it's ACV policy. We're running into that more, where now you have a 2% deductible and an ACV policy. And so the homeowners, you have a $30,000 roof, but the insurance is only paying out, 15. They might get half of the coverage. So yeah, that's that. I would say that's the biggest challenges. And I think what we're doing, and then that cash flow thing you're talking about, insurance companies just dragging out payments has really affected us. And so just the financing is a big part. Really, if we can have the homeowner just finance even the whole project, let them just keep the money and they can from insurance, and we just do the roof. That's the ideal that we're really trying to shift to right now. And the biggest challenge is educating the homeowner, and getting them to realize that the roofing companies that are offering to pay their deductible are not their friend, because they're going to cut corners. I have a friend, literally a friend at church, who ended up going to work for a different roofing company. I was actually trying to recruit him at one point, but now he works for another roofing company. And he was kind of bragging to me about how cheap they get their shingles, how cheap they pay their labor, because when they recruit sales guys, they're paid on profit. And so they can make more money. Like he makes more money there because how cheap they get their stuff. And I even asked him, so what are you guys doing about the deductible? He's like, oh, all the big companies come to deductibles. That's the way you have to do business here. So that's kind of the challenges we have. And they have now like 30 sales guys. They're doing like 42 roofs next month. They're like crushing it. And it's super frustrating to see. It seems like the companies that are doing things the wrong way are the ones winning right now in a way. I don't know if other roofers are feeling that. I think there is going to be a shift. I think we're in this transition period right now, though, that if we stick to our guns and say, hey, no, we're going to focus on quality. I'd rather do less roofs, better roofs, have good margin, or appropriate margin anyway. Because what's happening is these guys, it's like a race to the bottom. He's just going around finding the homeowners that don't want to pay their deductible and putting the cheapest roof he can on there is really what he's doing. And I feel like our job is to educate the consumer to not do that. And because he's just setting them up for a big disappointment in the future. Because if 5-10 years from now, they have an ACV policy, they have a 3% deductible, they basically have no money coming for their roof. And then their roof actually does get damaged. They have a leak. They have to replace it. At that point, they're going to have to finance a way more expensive roof because of inflation and all that. And they're not going to have much insurance help for it versus someone who put on a really good roof and they avoid that having to replace it or file a claim or anything is going to set them up better. So that's
Absolutely. And those are, frustrations and changes we're hearing from plenty of other folks too, market forces trying to, and competitors push you into committing fraud to either go out of business faster or end up sharing a jail cell later. It's like those are the only alternatives or the only endpoints of, covering those huge deductibles. And, our in the news just this week, there's a huge fallout from one of the big PE-backed groups in the country, home improvement space, that declared bankruptcy. 2,500 people are out of a job, and a bunch of customers lost deposits, and it's just an absolute mess. And it's showing those big companies can be giving the perception that they're killing it. The volume is vanity type of reality when no profit is actually coming in, and it's just a house of cards ready to fall. So it's encouraging that consumers are at least getting tired of going through these replacements, seeing this upward trajectory in deductibles, and pushing you guys for better solutions, which you can then come and be talking about and really change the conversation and not just be in that race to race to the bottom. But how are you trying to introduce that, or and train your salespeople to introduce those alternative options? Where in the process do you start trying to have that conversation with folks?
Yeah, that's been I would say a little bit of a moving target, just trying to figure that out. Because if you try to introduce it too early in the process, homeowners can get scared of the price and think, oh, this company isn't for me, and then end up going with one of the other companies. Versus if we can get them to the point where we have their claim, we're sitting at the kitchen table, we know how much insurance money they have, and we can show them the demos, talk about the changes in the industry, and the homeowner really understand that. That's when the homeowner will realize, okay, it makes more sense to invest a little bit more in my home instead of just trying to do the cheapest thing. A good example is literally just yesterday, we were doing a roof in a nice neighborhood in the Dallas area, kind of a 55 and older community. And the homeowner that we're working with, he paid for a couple upgrades, putting a really good rubberized asphalt class 4 roof on with like solar powered ventilation, everything. And there was a few homeowners around him that hadn't replaced their roofs yet. And these are kind of older storm damage And so you kind of wonder, like, okay, why have these other homeowners not replaced their roof yet? Well, the homeowner right behind him, I was with one of our sales guys and we both knocked on the door together. And she was like, oh, maybe you can help me with my roof. I need to have a repair. I have a couple shingles that blew off on the top. And I'm like, oh, okay. And we kind of just got to talking. And she's like, yeah, Allstate denied my roof like last year, about a year ago. And then we were basically talked to her on how we can get that turned around and through appraisal process and things like that, because she just didn't understand that. Allstate came out, denied it, and she just thought, okay, well, I'm just gonna have to pay for repairs now. Well, one of the first things she just assumed we were going to do is cover deductible. She's like, oh, and a lot of sales guys right away that don't cover deductibles, they would try to explain it to her right then, like, oh yeah, we follow the law, we're not going to do that. That would have totally scared her off. We kind of just ignored when she kind of made these comments that she kind of assumed we're just going to cover it or it's going to go away, because we really need to get her to the kitchen table, sit down, like. And sometimes as a salesperson, they feel like if they spend all that time like meeting with the adjuster, going to appraisal, getting the roof paid for and helping this person, and then they would get there and then they would go do someone else that would cover the deductible. Most homeowners actually wouldn't do that, just because once you spend that much time, build that relationship, and they see that you help them get their roof paid for, then when you sit down, you explain how it works. I feel like she would end up just paying the extra amount, or her portion of her deductible, because we do some complimentary upgrades. So as long as they pay their deductible, they're getting a class 4 roof. And they're getting the insurance discount and all that. So it makes sense for them to do that. But to try to explain that to them when you're just standing on their porch the first time is usually a hard way to do it. And so we're really training our guys to like, hey, just take them through the process, serve them, help them. We're going to tarp her roof. We're going to help her get her claim approved through just our documentation and all that. And then we'll kind of cross that bridge when we get there. So that's kind of what we're having to do, just so the homeowner can go through and build the trust, educate the homeowner, and she can realize times have changed, because she just thinks it's just like it was 10 years ago, because she hasn't replaced her roof in over 10 years. So she's thinking that she'll just get her deductible covered. So that's her mindset.
Really interesting. It makes total sense. You're not asking the customer to make decisions until they have the information they need to make that decision. So, and just delaying it and getting all the pieces in place to give yourself the foundation from which to have the best conversation. So, and that's encouraging for all of us too, that have a little faith in the humanity of your serving. You'll have the occasional one that'll leave you hanging, but most folks, they're going to understand what you've done for them and value the relationship they have with you along the way too.
Yeah. And I think another thing too is once you sit down, you can like show them how, if they finance the out-of-pocket portion that they have, that the insurance discount they're getting in a lot of cases covers the payment on the financing. And so their actual net out of pocket can actually be zero in a lot of cases, but also in the future is protecting them more to actually save money in the future. So if they just really have to see that times they can't keep, and she said her deductible's gone up since even she filed that claim a year ago. So that also gives a sense of urgency. Why not to allow, because really insurance owes for that claim that she had already filed, which the deductible would be based on that, what it was a year ago, not what it is now. And so if she were to wait and just do nothing and pay for the repair, not only is she paying out of pocket money for the repair, she knows she's going to have to file a new claim. Maybe she wanted to wait for a next storm. Her deductible might be double at that point, what it was a year ago. And so right now is actually a good time to create a sense of urgency for homeowners to, if they have damage, they shouldn't wait. They need to just go ahead and do it and then put on a better roof. So get your roof upgraded now so you're protected for the future. So that way you're not dealing with a 3% deductible, or 2% for sure. Mm-hmm. A lot of the carrier, I've heard stories about State Farm even trying to leave Texas too, kind of like they've been abandoning California and a little bit in Florida and stuff too. So,
Well, it's going to be interesting, and those guys carry a lot of weight, and so they have seen that when they pull back from these markets, the states make changes to get them back because they don't want the alternative of not having that carrier. So they may start using it as leverage too. But I'm just curious on that. Just spitballing, how much more frequently are you, having to take jobs to appraisal, and how much more frequently are you guys having to rely on, supplementing to get the profit you need on a job?
Yeah, I mean, I would say kind of how we do it now is we always have to supplement a job. I mean, I would say 90+% of the time anyway. Every now and then you'll have where we meet with the adjuster and he writes up a appropriate amount that works. But that's pretty rare now. It used to be probably about 50% of the time that would happen. And the other 50%, you're really relying on supplementing. And then we never had to go to appraisal. But in the last 2 years, and then up to this year, I would say 50% of our claims were taken to appraisal to get paid. So we might initially look at them and then go ahead and try to supplement initially, because you have to create a dispute anyway. So it's like you need to have an estimate sent to them with documentation. And then when they come back basically saying, hey, we're not paying for that, we used to try to keep supplementing it, and we let it sit, for 30, 60 days and then go to appraisal. But now our time and process just got ridiculous. So now what we do, it's basically about a 10-day time frame. If we send in our estimate and they reply back one time, basically denying most of everything, we just immediately just send in an appraisal. We have our appraiser reach out to the homeowner, build that relationship, and then send in the request for appraisal.
Wow.
And what happens sometimes is they go ahead and do the appraisal and then get it done relatively quickly, or the insurance company says, whoa, before you go to appraisal, let us look at your supplement again, or let's do a reinspection. I just had one recently where, it was Allstate. They said, hey, we'll do a reinspection. The guy that came out was great. He looked at everything and wrote up a very fair estimate that we really don't even have to supplement. Maybe a few little code items. And then we're good to go. So we didn't even end up going to appraisal, but we had to threaten appraisal. The homeowner did, the homeowner had to take that step. So we're having to do that probably 50%, maybe even more of the time. So.
Which 10 years ago when you started, and we were, we've been working with folks too. You didn't hear about that hardly ever. So.
No, I didn't even know what an appraisal was 10 years ago.
Yeah, me.
If someone asked me what an appraisal was, I couldn't even tell them. Yeah.
No, and that's obviously we get really excited and have some vested interest in the Texas Proof Roof program with our Castlewood shingle, and trying to provide folks a better product moving forward and just getting out of this constant cycle. But not only is it's better for the homeowner getting them out of this cycle, but then it's a game changer for you folks when you're able to do all that work, all that extra work you're having to do no matter what now on a regular basis. But if you can convert that into a higher margin, bigger ticket item like a metal roof, build a whole lot more value, you can be rewarded for it. And, totally change the conversation, and from the whole, race to the bottom, cover the deductible, all of that. So, appreciate what you guys are doing and building, and have appreciated the chance to learn from you along the way. But before we wrap up here at the end, we'll give everybody a chance to ask Brad questions, and here as well. So Brad, thank you again for being super gracious and sharing all of that with us.
Yeah, my pleasure.
So we just wanted to finish here with a couple of quick ideas in addition to, sort of what Brad has been sharing on things you might want to start thinking about in your business of responding to these changes in the market, and how we're going to be able to still accomplish our goals moving forward. In addition, Brad touched on it here of a video that he had with his his friend in the insurance business, but really love what they're doing as well of in their marketing, taking a very educational approach to get out in front of this with consumers, of building a brand of that expert who cannot come alongside and help them navigate this, and then help them also avoid it in the future with these more premium solutions. So definitely recommend this. Recommend that you follow Marcus Sheridan, read his book Endless Customers, and really start leaning into taking this educational approach, answering the questions of your customers to become the known and trusted brand in your market and the one that can best serve them. And encourage you to start thinking through what that opening the conversation to more premium options looks like in your sales process. Again, for the interest of the homeowner and your company of getting sort of insulating yourself too from this current arrangement. So wherever that falls in the process, in the sales process, maybe some scripting like this, where you ask, are you aware of any changes to your home insurance policy that has affected your roof coverage? And regardless of whether they say yes or no, following up with something like, unfortunately, we're working with more and more homeowners who find their insurance coverage falls short of the true cost of replacing their roof. Would you like to consider options, or once we reach the point, know what your claim value is? Would you be interested in considering options that might cost a little bit more, but leave you better protected and eliminate the need to save for future unexpected expenses? Or another version of this that we've and others have been using, something like, because of these changes, we are all having to consider ourselves to some degree self-insured. Do you want to do that by investing in a better product now to leave yourself better protected? Or do you want to be in the position of saving a little each month, hoping that you have enough when the time comes that you need it? With this type of scripting, you can start just introducing this idea of maybe there is a better way to do this than just replacing the roof with exactly what's up there now. And really help homeowners become aware of a problem they didn't know they had. Brad said it. Most homeowners aren't even aware of these increased deductibles, ACV policies, all of this that is going to have a significant impact on them and change what this looks like now versus the last time they looked like they replaced the roof. So making them aware of that problem, if you can then solve the problem, you then build a whole lot of value in your solution. As a metal roofing manufacturer, we obviously believe that metal should be depreciation proof. It'll perform just as well 30 years or 40 years from now as it does today. But that's probably a futile fight with the carriers at this point. What we have had success with is helping homeowners who get that letter from the insurance carrier saying you need to replace your 10 or 15-year-old roof. So we've outfitted some of our contractor partners with a letter, something like this, that they can give homeowners that talks about that the roof hasn't degraded. It carries the same warranty. It carries the same testing data and performance standards at year 15 as it does at year 0, and replacement isn't necessary. With our lifetime non-prorated warranty for that homeowner, that becomes a pretty simple conversation. And we've had a lot of success helping folks. So if you can get out on the front end of, again, helping them avoid this in the future, that can be some value. So if this would be of interest, get with your territory manager. Happy to help with that as well. And then like you heard from Brad, if homeowners are having to pay more than they expected to pay, or what they never expected to pay, then we need to offer financing solutions to help cover that gap. And if you're already getting them into a monthly payment, some upgrades to increase that monthly payment by a little bit becomes a much more interesting conversation rather than talking about gross dollar numbers and thousands of dollars. So cannot encourage everyone enough to get set up with a good financing option. Here's some examples of companies we've known our customers to work with. If you want a more detailed recommendation, don't hesitate to reach out, and we can help you with that. We have no interest or no kickbacks here, just passing along some connections that we've made over the years. Well, thank you again for making the time to join us today. We so greatly appreciate our relationship with each of you, and hope that, again, you leave with a better understanding of what's led to the market where it is today, where it's projected to keep going, and maybe some new ideas for how you can respond to it. Again, we're not successful unless you're successful, and we would love for this to be the start of a conversation on ways we can support you.
Thanks so much for tuning in to this episode of Construction Disruption from Isaiah Industries. Hope that this overview of the changing insurance market and some of the ideas that were shared helps you begin to lead your business through these changes to ensure that you still accomplish all your goals moving forward. If there's any way that we can ever help you do that here at Isaiah, please do not hesitate to reach out. And please watch for future episodes of our podcast. We are always blessed with great guests. Don't forget to leave a review on Apple Podcasts or give us a thumbs up on YouTube. Until the next time we're together, keep on disrupting and challenging those in your world to better ways of doing things. And don't forget to have a positive impact on everyone you encounter. Make them smile and encourage them. Two simple yet powerful things we can all do to change the world. God bless and take care. This is Isaiah Industries signing off until the next episode of Construction Disruption.
This podcast is produced by Isaiah Industries, manufacturer of specialty metal roofing and other building products.